About a week to 10 days ago, our social media news feeds, news app notifications, etc. were all abuzz about the news of Reliance's demerger. Now this week again, there was a lot of interest around ITC's demerger. So we ask, why is there so much of an interest around demergers? How does a demerger work and how does it benefit the business? Is it beneficial to the investors as well? Well, we will decode all of this in today's episode as we look at the demergers from the point of view of Reliance and ITC and understand its implications on the business as well as on you and I as investors. Now, while we do that, in the recent times, there has been a notable trend of Indians in America heading to departmental stores seeking to buy sacks of rice in large volumes. Now, these videos depicting their eager efforts to get hold of one bag of rice has gained widespread attention. Now, interestingly, some of the stores have responded by increasing the prices of rice and even implementing a policy of allowing only one rice bag per family. Now, why is this happening and what is India's role in triggering this? Let's find out. You're watching Informed Investor, the third empire, an initiative by Research and Ranking. Let's begin. Now, in the fast-paced world of finance, the announcements of two colossal demergers have recently captured the attention of investors and analysts alike, leaving the market in a state of awe and anticipation. Now, with billions at stake and industry titans involved, these momentous events have set a new precedent for strategic restructuring, signaling an era of profound transformation and opportunity in the global financial landscape. Now, before we understand the implications of these events, let's talk about what exactly is a demerger. Now, a demerger is a corporate restructuring event in which a business is broken into components either to operate on their own or to be sold or to be liquidated as a divestment strategy. Demerger allows a large company such as a conglomerate to spin off or split up its various brands or business units to invite or prevent an acquisition, to raise capital by selling off components that are no longer part of the business's core product line, or to create separate legal entities to handle different operations. Now, ideally, there are two types of demerger. The most common type of demerger is the spin-off. Now, a spin-off is a divestment strategy wherein the company's division or the undertaking is demerged into an independent company of its own. Now, once the undertakings are spun off, both the parent company and the resulting company act as separate corporate entities. Now, a spin-off usually leads to an advantage for the investors as shareholders enjoy the benefit of holding shares in two companies now instead of one. Now, from the company's point of view, the parent company gets to retain a non-controlling interest in the subsidiary, which can be a non-taxable event. Now, on the other hand, a split up is a business strategy wherein a company splits up into one or more independent companies and the parent company ceases to exist. Once the company is split into separate entities, the shares of the parent company are exchanged for the shares in the new company and distributed in the same proportion as held in the original company, depending on the situation. Now, the Indian stock market has had two significant demerger events over the past 2 weeks, and both of them have taken the spin-off route. The first event was the news of Reliance Industries demerging its financial services arm. Now, Reliance Industry, as we all know, operates as a conglomerate, meaning it's a multi-industry company that consists of several different and unrelated business entities that operate in various industries under one corporate group name, which is Reliance. Now, talking about the different verticals, they have O2C, which is their oil to chemicals business, oil and gas exploration business, followed by retail, the digital business, and now the financial services business as well. After getting the approval from LCLT, Reliance Industries fixed 20th July as the record date for the demerger process. Previously known as Reliance Strategic Investments Limited, it would now be demerged and listed soon on the stock exchanges and under the name of Jio Financial Services Limited. Now, for the demerger to take place effectively, the National Stock Exchange and the Bombay Stock Exchange conducted a special pre-open session from 9 a.m. to 10 a.m. on 20th July to minimize volatility and discover the opening price for both the entities post the demerger. Now, during that time period, the price of Jio Financial Services Limited was discovered to be 261.85 rupees per share, which was much higher than the brokerage estimates. Now, this price was then subtracted from the share price of Reliance Industries Limited to effectively phase out the spun-off business. Now, this bodes well for the investors of Reliance Industries who were awarded a 1:1 ratio for the demerger, which means that for every share of Reliance Industries Limited that they hold, the company will now award them 1 share of Jio Financial Services Limited to the existing shareholders. Now, the objective of the demerger was to tap the growing demand for new age financial services for retail and small business customers and operate independently. Now, another development that arose during the week was the news of Jio Financial Services entering into a joint venture with BlackRock, which is the world's largest asset manager, who joined hands in a bid to provide innovative investment solutions for millions of investors in the country. Now, the agreement will be a 50-50 joint venture and will be called Jio BlackRock with an initial investment of $300 million, which means $150 million each. Now, the partnership will be a significant one as it would leverage the respective strengths and brands of both BlackRock as well as of Jio Financial Services to deliver tech-enabled access to affordable, innovative investment solutions to all Indians. Now, this strategic move by Reliance into the financial services industry is to leverage its resources and expertise to establish a strong presence and capture opportunities for the growth in the dynamic Indian market. Now, while this was a significant event for the investors of Reliance, another demerger took the investors by surprise, and this was of the ITC giant, which decided to demerge its hotel business into a separate entity altogether. ITC Limited is another conglomerate that has diversified portfolio in the FMCG space, hotel and hospitality industry, agribusiness, papers, packaging, and paperboards as well. Now, several rumors about ITC looking to spin off its hotel or hospitality business have been floating around for quite some time. And now the management has finally announced that it is indeed going to spin off the hotel business. The hotels division will be demerged in an arrangement in which ITC, which is the parent company, will hold around 40% of the new entity, and the remaining 60% will be allocated to the shareholders in the proportion to their stakes in ITC. The new entity would be named ITC Hotels, and more developments regarding the arrangement would be released during the subsequent board meeting, which is scheduled to be held on 14th August 2023. Now, while research firm Morgan Stanley saw the demerger as a clear positive, many participants took the news negatively as the share price of ITC tanked 7% in 2 days. Now, many analysts reported this update to be positive as it would reduce concerns over capital allocation, as the hotel business is an asset-heavy business contributing just 2% of its EBIT but taking up 20% of the capital employed. Moreover, ITC can now use the cash flows of their cigarette business to develop other businesses over the medium to long term, which will help in the value unlocking of the demerged entities as well. However, this led to a drop of 7% in ITC's share price in 2 days, as many market participants were expecting a full split like the one seen in the case of Reliance Industries, where they are getting 1 share against each share and not the unfavorable demerger ratio as in the case of ITC. Now, this coupled with the profit booking in ITC added to the downside of ITC's stock price. Now, ITC's management is yet to declare the share swap ratio, mind you, but they did mention that the new entity, which is ITC Hotels, will be looking to attract strategic partners whose investment strategies and risk profiles are aligned more sharply with the hospitality and the hotel industry. Now, overall, in the long term, analysts still believe that it will unlock value of ITC and also of ITC Hotels, which will enable the hotel business to chart its own path and attract suitable such strategic partners to craft its new horizon of growth, leveraging the brand name of ITC. Now, the recent demergers in the finance world, particularly those of Reliance and ITC, have undoubtedly shaken the market and sparked a new era of strategic restructuring. Now, these demergers, both accomplished through the spin-off method, signify a profound transformation in the global financial landscape, setting a precedent for other conglomerates to consider similar moves. Now, as the financial world continues to evolve, it will be fascinating to see how the industry titans might follow suit, embracing strategic restructuring to maximize growth and capitalize on new market trends. Now, investors and analysts alike will undoubtedly keep a close eye on these developments as they signal a promising and exciting era in the fast-paced world of finance. Like we mentioned in the introduction over the last week, a lot of Indians in America were seen heading to departmental stores looking to buy large quantities of rice. Why is that? Well, on 20th July, India banned the export of non-basmati white rice to boost domestic supply and keep retail prices locally under check. Now, the government amended the export policy from free with export duty of 20% to prohibited with immediate effect in the case of non-basmati rice. Now, India's recent ban on non-basmati white rice exports has sent shockwaves across the global market, leading to them scrambling for supplies and heightening concerns over food security. Now, even the International Monetary Fund has encouraged India to lift its ban on the export of non-basmati white rice, citing potential global inflationary impacts. Now, rice is one of the most widely consumed cereals in the world and accounts for a large share of calorie consumption in many countries, particularly in South and Southeast Asia, and in some countries in Africa as well. Now, since 2011, India has held the title of world's largest rice exporter, surpassing major competitors like Thailand and Vietnam. Remarkably, in 2022, India's rice exports reached approximately 22 million tons, contributing to an impressive 40% share of global rice trade. Now, these exports encompass diverse grades and types of rice, including basmati, non-basmati white, parboiled and broken rice as well. Now, India has a wider range of rice buyers. India sells rice to approximately over 140 countries, with Benin, Bangladesh, Angola and other buying non-basmati rice, and Iran, Iraq and Saudi Arabia buying basmati rice. Also, India is a major supplier to rice to several important markets in Asia and the sub-Saharan Africa as well, making their populations vulnerable to rice market disruptions. 42 countries get more than 50% of their total rice imports from India alone. Now, as per the Mint report, India's rice exports last year were more than the combined shipments of Thailand, Vietnam, Pakistan and the US put together. Now, thus, India is evidently a very crucial player in the global rice trade. Now, data from APEDA shows that the share of non-basmati rice in India's overall rice exports has been rising quite steadily, as rice exports overall have also been growing. Now, India has no restrictions on basmati and parboiled rice exports, but has banned non-basmati white rice. Now, the move has both domestic and global implications. In FY23, it shipped 22.5 million tons to over 140 countries. About half of those shipments were of non-basmati white rice. These types, which are cheaper than the fragment long-grain basmati, are especially popular in poor places such as Bangladesh, Nepal and parts of sub-Saharan Africa. Now, a reduction in its supply will drive up the prices in these countries. It will also drive up the prices that these countries pay to India as well. Now, India's role in the global rice trade is in many ways similar to that of Indonesia and Malaysia in palm oil. While rice has more suppliers like Thailand, Vietnam, Pakistan, US and Myanmar, they cannot fill the vacuum which will be left by India's curbs. Now, a surge in world prices is therefore inevitable. Now, India implemented a ban on all exports of non-basmati white rice due to various factors. Now, the decision came in response to a surge in international and domestic rice prices and a decline in the rice cultivation in several key rice-producing states, which was caused by an erratic monsoon season. Now, the ban was put in place immediately as a response to address these issues. Now, the government is taking measures to mitigate inflationary pressures, especially given the upcoming state and national elections. Food prices, particularly rice, hold immense significance in India, where they constitute a significant part of the diet for low-income individuals. Now, the primary objective of banning rice exports is to ensure an adequate domestic supply and to prevent further excarceration of domestic inflation. Now, the Indian government aims to safeguard the availability of rice for its own citizens during a time when market forces and unpredictable weather patterns pose a potential threat to rice cultivation and the rice prices as well. But how does this impact India's image as a biggest rice exporter? Now, this is not the first time that the government has taken such a step. Do you know that the government had done this several times in the past as well? During the FY 2008 and during the FY 2011 food price crisis, India banned exports of rice, mostly the non-basmati white rice, for extended periods as well. Now, India has also said that they'll still allow for some exports. This is if a country reaches out and convinces us about their food security concerns, but it may still not offer respite to global prices. While imposing export curbs may be justified under exceptional circumstances, the government must be really mindful of its image as a reliable global supplier. Now, a significant aspect of international trade is reliability and consistency. When a country becomes a reliable supplier of agricultural commodities, it gains the trust of import-dependent nations, particularly those in the African regions and the other regions as we've mentioned. Now, building and maintaining trust in these markets takes time and a lot of effort, but it can be easily eroded by sudden export bans or restrictions. Now, such actions might force importing countries to seek alternative suppliers, leading to potential long-term damage to India's export markets. Now, it's crucial for the government to balance short-term domestic concerns with the long-term impact on its image as a dependable global supplier. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.